So we'll go ahead and get started today. And again, I want to personally thank you all for attending today. I know this is taking time out of your busy days. And so whether you're one of the participants in the many corporate 401k plans here that the Noble Group advises on, wealth management, financial planning client, or just one of our strategic partners, we welcome you and hope that this webinar will be filled with information and then motivation to potentially make some changes in your financial plan. So. And I wanted to say, we're never here to sell anything. We're just here to inform and educate and kind of show how we can help. And then we're not tax preparers, but we are tax planners. So we'll work with a team of advisors such as CPAs, tax advisors, to make sure investment and financial planning match the legal aspect of your tax plan, if that is something that you wanted to help us with or help you with in the future. So, but let's see. So these presentations are meant for high-level education. Each of your situations is extremely unique. And so please don't ask super specific questions when we get down to Q&A at the end about your role and anything else. You'll get an email from me most likely tomorrow with a recording of this video, plus a way to schedule some time on my calendar if you want to talk about your unique situation. So, and now that I know you guys have all read through these disclosures, let's go ahead and get started. All right, so first we'll review the agenda. We're going to talk about what tax planning is, who it's for, and why it's beneficial for everyone to go through a tax planning process. And to understand tax planning at its core, we have to understand how the tax system works. And so we'll do a high-level review of the federal tax system. Then we're going to get into the meat of the tax planning presentation with ways to start lowering your taxes, both now and in the future. All right. And then we'll end with some action items and Q&A. And so you can submit your questions at any time through the chat, and we'll get those answered as best we can at the end of the presentation. So tax planning is aimed at lowering your tax burden both now and in the future. We help our clients do this by carefully reviewing their tax returns on an annual basis and determining the best approach for their unique needs. And you also don't have to work with a financial planner to accomplish this. Every action you take to minimize tax liabilities and maximize your tax deductions will have a far superior return on your money over time than doing nothing. And so who is tax planning for? In short, everyone, right? Whether you're single, married with children, a small business owner, or someone looking to pass down money efficiently, tax planning plays an essential and unique role. The sooner you can start tax planning, typically the better the situation. Don't be alarmed if you haven't done much, as there's always opportunities to make an impact with tax planning. And while tax planning is an important piece on your overall financial plan, it's just that, a piece of the pie. Right? A well-rounded financial plan, including tax planning, investment analysis, risk management, estate planning, and goal monitoring, will set your financial future. Right? Whether you're worried about impending retirement or still have another 20 years to accumulate before retirement, having a flexible financial plan that shows the outcomes of various financial decisions will make it easier to sleep at night knowing you're on the right path. So why do I need tax planning? This is a question we get quite often. And really the answer is because taxes touch every part of your financial life. When we start a new year, taxes are usually at the top of mind, and reducing our taxability is usually at the top of that list. And with the Tax Cut and Jobs Act sunsetting this year, we have a window of opportunity to take advantage of lower tax rates in 2025 before they increase in 2026. Okay. Now, we don't know what the new president and everyone is going to do moving forward with the Tax Cut and Jobs Act. There's been talk about pushing it forward into future years. There's a lot that has to be figured out there. So right now we're still planning on these increasing in 2026. But even if they don't, and we push this out a few more years, the national debt is over $36 trillion at this point. And at some point in the future, we're going to have to bring in higher tax revenue to offset the increased cost of the debt that we have. So, and the thing that I want to take is when we talk about tax planning, your tax return is your financial fingerprint. Okay, it's completely unique to you and it's completely valuable clues and information, all of which are buried in dozens of pages and hundreds of numbers. And so you have your tax return, and that helps with tax planning. Okay, so now that we understand who it's for, what it is, and why we would want to get into it, let's look at the foundation of the U.S. tax system and how it works. Okay, the U.S. uses a progressive tax system, meaning that as your income increases, so too does the percentage you pay in taxes. There are 7 federal tax brackets: the 10, 12, 24, or excuse me, 22, 24, 32, 35, and 37% brackets. So in general, someone making $50,000 a year will be in a lower tax bracket than someone making $250,000 a year. But no matter what bracket you're in, you probably won't pay that rate on your entire income. With the progressive tax system, the government cuts your taxable income into chunks and then taxes each chunk at the corresponding rate. Here's a quick example. A single person with $100,000 in taxable income per year will have some of their income taxed in the 10% bracket, some at the 12%, and the remaining amount at the 22% bracket. This leaves an effective rate of approximately 17%. Okay. Again, and so just remember, the main goal with tax planning is lowering your effective tax rate, that 17% that we talked about, and that's what your income is taxed on. So if we can lower our taxable income, either now or in the future, that will lower that effective tax. Again, effectively what we pay as a percentage of our income in taxes. Okay. So speaking of income, let's look at how your income that you're taxed on is determined. Okay. First, we start with what's called adjusted gross income. Okay. This is your total income from earnings and investments, retirement income, minus any deductions that you have. Again, what we call above the line. We're going to get into that in a minute. Okay. Modified adjusted gross income. All modified adjusted gross income is your adjusted gross income with certain deductions added back in. Biggest example here is tax exempt interest. So if you have municipal bonds or something similar to that that's paying tax-free income from those, your modified adjusted gross income adds that back in. That's important, as we're going to jump into that a little bit later, because those are what we typically use modified adjusted gross income to figure out certain deductions that we can get. So again, we'll get into that in a little bit. Okay. And then taxable income. This is probably the most important number because as taxable income, or as we have our taxable income, that determines the amount of taxes we're going to pay. Okay. So taxable income, again, very important. Now let's look how we get to taxable income. All right. So deductions and credits are all over the place. Maximizing deductions and credits is how we lower our effective tax rate. Again, effective tax rate determines the amount of tax we actually pay. But all deductions aren't created equal. There are many rules when it comes to taking deductions and credits. Okay, so knowing the difference between above the line versus below the line deductions is important for individuals and business owners when tax season comes around. While both can potentially reduce your taxable income, there are some nuances that are essential to understand. Okay. So above the line, any item that you subtract from gross income to arrive at your adjusted gross income, such as IRA contributions, student loan interest, and health savings accounts, we add up your total income and subtract these deductions to determine your adjusted gross income. Okay. Once we have adjusted gross income, and that's been calculated, below the line deductions are deducted to arrive at your taxable income. Right? The deductions come in 2 forms, standard or itemized, and we're going to jump into those in a second. Okay. Effectively, these 2 types of deductions have different functions and are applied at different stages in that whole process of calculating your taxable income. However, both deduction types help you reduce your taxable income, thus reducing your effective tax rate. Okay. So let's look at the standard deductions here. So everyone is entitled to a standard deduction, no matter what your income level is. As you can see in the chart, the amount of the standard deduction depends on your filing status for taxes and your age. Okay. So as we review this, if you're single or married filing separately, your standard deduction is $15,000. Okay. Essentially, you're getting $15,000 off your gross income to get to, or off of your adjusted gross income to get down to your effective, your taxable income. Okay. If you're married filing joint, that's a 30,000. And for age 65 and older, if you're single, you get $2,000 extra. And if you're married, each person gets 1,600 or 3,200 total. So, and then there's some things for blind and a few other things that come in there too for additional deductions. But so once your AGI is determined, we just subtract the standard deduction from your adjusted gross income to get that taxable income. Right? The other option outside of the standard deduction is itemized deductions. And this involves adding up all of your individual deductions. Most people tend to choose the standard deduction because it's less work and often works out to be more than the itemized deductions. However, your tax advisor may advise you to opt for itemized deductions if it's the most financially beneficial option for you. Common itemized deductions include items like property taxes, mortgage interest, and charitable gifts. Okay, so now that we understand the foundation of the tax system and who tax planning is for, let's start getting into what we can do to start saving taxes both now and in the future. Okay, so first thing we're going to talk about is how we can contribute to workplace retirement plans. Most of you on this webinar probably have a 401k or something similar to that at a workplace. So what we want to talk about is the two different types of 401ks, okay? Traditional and Roth. One is tax deferred, meaning that we make pre-tax contributions. We pay no income taxes now on that money. They grow tax deferred, meaning that we don't pay taxes as they grow, sell, do anything in there. And then when we withdraw our money that we've earned during retirement, we pay income taxes on those withdrawals. And on top of that, right now at age 73 for those born before 1960 and age 75 for those born 1960 and after, we have what's called required minimum distributions or RMDs. This is where the government mandates that we pull money out on an annual basis. At 73 and 75, the approximate amount that you have to start pulling out is 4%, and it raises every single year. Okay. So that's what the traditional 401k. With the Roth is just pretty much the exact opposite. Okay. So the money we put into the Roth 401k, we pay taxes on now, but then the investments grow tax-free. It's technically called tax deferred, but it's tax-free as long as we use it in retirement or some other form where we can go get that without penalty. Okay. When we withdraw those contributions in retirement, again, typically 59 and a half or older, we pay no income taxes on those withdrawals. So we pay taxes now on the amount we put in, and then we never pay tax on that again, as long as we adhere to the rules that the IRS makes us have. Okay. So how do you know which one to do and which one not? This is specific to each individual, right? Somebody making a lot of money might need the deduction now because their retirement income is going to be lower when they are in retirement. So they might pay less taxes in the future than they are going to now, again, holding that tax rate stay the same. A Roth 401k may be more beneficial to those with a little bit less income and then aren't paying quite as high of a tax rate and have the funds to pay the taxes on that money that's going into the retirement plan. Because when they get to retirement, all that money in the Roth 401k is going to be tax-free. So those are ways that you can mix and mingle, right? And we're going to get into the total amount we can put into these type of plans here in a couple of slides, but we can mix these together, okay? And so we can have some traditional, some Roth, and we can get those deductions there, okay? For now and in the future for tax-free income. Okay, like a 401k, we also have traditional IRAs or individual retirement account and a Roth IRA. Okay, for those not familiar, they work basically the exact same as the traditional 401k and the traditional IRA. The difference is that I in the IRA, the individual. So anybody can set these up. You do not have to be covered by a workplace retirement plan. You can have a workplace retirement plan and still use these, just depending on a few factors if you get deductions or not, okay? So again, with the traditional IRA, we're basically going to pay taxes later. So we get a deduction in most cases for putting money into the IRA now, but the income is taxed when we pull it out in retirement. Again, required minimum distributions are required at 73 to 75, depending on your date of birth. Okay, so traditional IRAs can be a great thing to help lower your taxes now. And again, we're going to get into numbers here in a second. Okay, Roth IRA, again, fairly opposite. We're going to put money into the Roth, but we've already paid tax on it. Okay, it's counted as our taxable income for the year. So we put it in, we get no deduction for it, but now they're going to grow tax-free until we take the money out. Again, most of the time over 59 and a half. But when we do take that out, it's tax-free. Okay, so, and the great thing with the Roth IRA and a Roth 401k is there's no required minimum distributions on the money while you own it. Okay, so there's some things with beneficiaries that inherit it outside the scope of this presentation. But if that's something that you're looking at, just give us a call. We're happy to walk you through it. Okay, so now let's look at the numbers of these and why this is so important to look at. Okay, so when we look at tax-deferred versus tax-free, remember we talked about modified adjusted gross income, MAGI, or what we like to call MAGI. Okay, MAGI is very important because it sets all of these numbers of what we can get deductions for or what we can contribute into. Okay, so first off, the contribution limits, how much we can put into these accounts. Okay, IRAs and Roth IRAs are the same, $7,000 if you're under 50, or if you're 50 or over, we do get $1,000 catch up every single year. Okay, so for those of you that have not put in and are able to put into an IRA or a Roth for 2024, you have until April 15th to do that. Just wanted to put that out there for those that are new to this and haven't done this. If you have the money and you either A, need the deduction for 2024, or you want to get it into the tax-free Roth account, you can still do 7,000 or 8,000, depending on your age, into the IRA or the Roth. You cannot combine those. You can't get 16. It's 7 or 8. If you're under 50, you can put 7,000 between the two or in one or the other. Okay, 7,000 total. Okay, same with the 401k. Okay, the reason why a 401k is so great is because most companies have a match. Okay, so when you put money into the 401k, your company is going to match you up to certain percentages and limits. Every company is different. Okay, so we call that free money. Right, you don't get a match in an IRA or a Roth. You get it in a 401k or a Roth 401k at most places. Okay, so again, under the age of 50, the limit for 2025 is 23,500. That's the most you can put in, plus your employer match. Okay. For 50 and over, you do get a additional amount of 7,500 that can go in. So for a total of 31, that's our catch-up contribution. Same thing as the IRAs with the 401k and the Roth. These are the total that you can put between the two accounts. Okay. So we can't go put 62,000, 31 each into these. 31,000 is our max. Okay. Now, for any of those business owners out there, whether it's you or own the business, your spouse owns it, there are ways to get more money into accounts like these. And even those that are W-2 employees, there are ways to do this. It's very plan specific. If you want to know more, just reach out to us. Let us know. We're happy to walk you through what those are called. Okay. Now, missed that one. Okay, so now let's talk about phase out for deductions. Okay, this is extremely important. When we put on here covered and non-covered, okay, covered means you have a workplace retirement plan. If that's the case, we'll just talk about the married filing joint right now. Okay, if you make more than 126,000 and less than 146, you're going to have a phase out of getting a deduction for putting into the IRA. Okay, now, if you make more than 146,000, and again, this is modified adjusted gross income. So this is essentially all of our income. Okay. If you make more than 146, you do not get a deduction to put into the IRA. Okay. So it's important if you do put in and you don't get the deduction, you now have after-tax money in a traditional IRA, which can become a very big pain. So there's only certain reasons we do that. But again, if that's something that you have and you want to understand how to plan around that, again, just reach out to us, let us know. Okay. For those that are not in a workplace retirement plan, that's the non-covered. Okay. So the deduction ranges or the phase out for the deductions grows quite substantially. Okay. So same thing applies. If you make under 236, you get a full deduction. If you make over 246, you get no deduction. Okay. Now with the Roth IRA, this is going to be a little bit different. Okay. So For a Roth IRA, it's not because you don't get the deduction up front. This is a phase out of contribution, being able to contribute. So same thing applies here. If it's less, if you have a modified adjusted gross income of less than 236,000, you can fully put in the 7 or 8,000 if you're over 50 into the Roth for each year. Okay. If you make more than 246,000, you cannot contribute directly to a Roth. Looking back at the after-tax IRA, there are something called a backdoor Roth IRA contribution, where we use an IRA with after-tax and what's called a conversion over to a Roth. And you get no tax deduction, but you pay no tax on the conversion. For those that are interested in that because they make more than 250,000, then give us a call. We'll help explain that too. We got some good checklists and things that you can go through to do that. Okay, or we can always help. Okay, so that's really important. One big difference between the IRA, the Roth IRA, and the 401k and the Roth 401k is you can have $1 million of income and you can still put 31,000 if you're over 50 into a 401k, right? That's in a Roth or a IRA, those aren't quite the same there. So a couple of things to think of there. Yeah. All right. So let's look at how we can take advantage of out-of-pocket medical costs and get a deduction for that. For anybody familiar, a lot of 401k or a lot of workplaces have health savings account as an option, but a lot of people don't know the benefits of an HSA. Okay, so a health savings account is a tax advantage way to save for qualified medical expenses or even retirement down the road. And so HSAs pair with high deductible health plans. Okay, and we're going to get into the numbers of what those look like. They're used typically for either near-term medical expenses or even expenses in retirement. I think we all know that medical costs are rising every single year. And the biggest thing that we've seen over the last 10 or 15 years for people in retirement is that cost of medical care and insurance every single year is what we plan for has more than doubled in the last decade. So we're seeing quite a high inflation in that cost. So having something that can help you and get tax benefits, what we call triple tax benefits, is great. So the way these work, your contribution to an HSA, whether you take the standard deduction or itemize, is going to reduce your taxable income. Okay, so you get the deduction for that. Okay, now it grows tax-free and you can invest it. Okay, so this is different than flexible spending or FSA account because you cannot invest that most of the time. Okay, but the basics are it grows tax-free, and as long as you use it for qualified medical expenses, you take it out tax-free. So that's the only thing out there in the financial world that has a triple tax benefit. Okay, so very important. Let's look at the contribution limits here. So we can see we had a little bit of change from 24 to 25. And again, you can still contribute to your HSA for 24. So if you haven't done that, might be good to do. You can see if you're single and you're only on the plan by yourself, $41,000 or $4,150 is the contribution limit. That's the most you can put in. That does include your employer match. So if some employers match an HSA, that's the max between the two. So just make sure you check with your HR department on that when you sign up. Okay. I'm sorry, in 2025 is 4,300. So we did see a little increase there. Okay. So if you're 55 or older, remember that IRAs and 401ks are 50, HSA is 55. If you're 55 or older, you can add an additional $1,000 in contributions per year. Okay. Minimum deductible health plan that's allowed to contribute to an HSA for a single person is $1,650, and for a family is $3,300. So if your deductible is lower than $3,300 for a family, you cannot contribute to an HSA. Okay, and then the maximum out-of-pocket limit. Okay, so all of these healthcare plans have deductible and the max you can pay out of pocket for the year. And those numbers for 2025 have increased too. And so if the maximum out of pocket is under 16,600 for family, then you can contribute to the plan. So very important rules. And there's a lot of inner workings on this. For those that are interested, here in a couple of weeks, we're going to be doing another webinar specifically on health savings accounts. So watch out for that invite coming out later this week. Okay, so charitable giving. Okay, not everybody is charitably inclined, but these are really important things to understand. Okay, so charitable strategies typically fall under itemized deductions. Okay, so for anybody that gives to Goodwill, your local church, if you tithe, these are all things that can be charitably deducted as long as they're eligible 501c3 public charities. Okay, and so depending on how much you give, this may be something that you get a deduction for. Something to think about before we jump into some of these other strategies real quick is if you're still using the um, standard deduction, but given to charity, you may look at what's called bunching um, those charitable gifts. Okay, so that maybe one year you itemize, the next year you use standard deduction. All that depends on how much you're given to charity. Okay, it's just something to think about if you're giving to charity, because that means you're not really getting the deduction to do that. Again, charitable giving is typically leads the forefront that we want to give to charity. But if we have the ability to get deductions for it, let's go ahead and see if we can take advantage of that. Okay. Another way to do that is using something called a donor advised fund. Okay. And this is something that's really important, typically for those that have a little bit higher net worth, because we do want to fund those with a little bit more money than just say a few $1,000s a year going to someplace. But it's a dedicated account where we get a deduction now, and then we can invest it and grow and use it anytime in the future. And we're going to try jump into this a little bit deeper. Okay. And then we have other things. These are typically for people closer to retirement or high net worth. But these are plain gifts that pay income either to the grantor or somebody that's giving the money to the charity, or it'll pay it directly to the charity and retain the assets for you. So things like charitable remainder trust, league trust, charitable gift annuities, and pooled income funds. These are things that are a little bit more advanced planning that can be done. Donor advised fund is pretty simple. So we're going to kind of walk into that strategy real quick. Okay. So a donor advised fund, again, basically we get our tax deduction now. We're going to give either cash or property to our donor advised fund. What we see the most is over the last decade plus, we've seen a big rise in the stock market. So we're able to take some of these appreciated securities, say, NVIDIA or Tesla has, grown over time, and we don't want to pay tax on that. So we can take some of that, move it directly into this charitable donor advised fund, and we get a tax deduction up front, and then we can liquidate that, diversify inside the fund, paying no taxes on the gains. Okay. So it's kind of a double tax benefit there, while then also supporting the charity or charities that we like. So it's really a great thing. And if we're using it as an estate planning tool, those assets that we put into the donor advised fund are held outside of the estate. Not a big deal for a lot of people now with $20+ million estate tax exemption for couples, 26+ million. So ultimately, that's not a big thing for a lot of people, but those things do plan to come down in the future. So these could be an estate planning tool in the future as well. Okay, so important here to look at is kind of the simple ways that we have to lower these. These don't cost a lot of money to do. They're typically saving for retirement, and that's really important. Okay, so one thing that we like to talk about here is, okay, that's charitable giving. Some of us have investments, okay? And when we talk about investment losses to lower our tax bill, what we're talking about is our after-tax accounts. So brokerage accounts, investment accounts, things like that. Okay, so think like your bank account, CDs, investment accounts that are not in retirement accounts. That's where we can take some of the losses that might be in there and use those to offset income in the future or now. Okay, so tax loss harvesting, right? This is a very powerful strategy year in and year out. If we all had that crystal ball, right, that said, this stock is going to do so well, and then it's not going to do so well, so we're going to sell it right there. If we all had that, we'd all be great, right? But nobody has that. Not a single person out there has that, or can do that strategy for a long time if they maybe hit it in a year. So what we end up with when we diversify an investment account is losses in some of the positions. But what we get with that when we sell those is a tax loss. Okay. which is great because what we can do is offset any gains that we have from many things, from other gains in the investments, from selling a business, even ordinary income up to a certain amount. Okay, so we would like to capture that tax deduction where we can, and then reinvest the money back in something else that we think is going to do better over the next period of time that we're going to invest that money. The one thing I'd like to say is this is very unique to each individual person. Okay, so somebody's sell of Apple stock now might be a loss, but somebody else might have a huge gain in it. So it may not be something where we say sell Apple now and it works great for everybody. Okay. So one thing that we always talk about on tax loss harvesting is the wash sell rules. This is really, really important if we're going to harvest losses in our investment accounts. Okay. Okay, so the wash sell, very simple. This is a basic concept, and it's fairly straightforward. Its purpose is to limit someone from tax loss harvesting just by selling an investment for a tax loss and immediately buying it back again. Okay, because this would result in a tax savings in the form of the deductible loss without the investor substantially changing his or her economic position at the end of the day. Okay, this is an older rule, but we see people get hit up by this quite often, where they took a loss, reinvested in basically the same security, and it's disallowed on their tax form. So basically, if you buy the stock within 30 days, either before the sell or after the sell, it's a 61-day window. So 30 and 30, the day of the sell, that loss doesn't count. Okay. So it states that you cannot buy a substantially identical investment to the one that was sold for loss. Okay. Quick example. If you sold Ford for a loss and then bought it back within 30 days, it would trigger those wash sell rules and be disallowed. Okay. But if you sold Ford and bought GM, you'd be in the clear. That would be fine to do. Okay. So we can sell something and buy it back. For any mutual fund or ETF investors, you can buy one mutual fund or sell one mutual fund, buy another. Okay. A similar, but not the same one. Okay. So let's look at an example of how this can save money. Okay. So we get to deduct, these are called capital losses. Okay. And we can deduct those against capital gains or ordinary income, depending on how we want to use those. Okay. So if total gains exceed our total losses, so we have more capital gains than we do capital losses, then we use those losses to offset the gain. Okay. Again, we've got some other videos out on our YouTube channel that discuss the capital gains tax rates and all that a little bit deeper. So feel free to get out there and look at those. It really talks a little bit more in depth in about a 9-10 minute video. It's pretty good for anybody interested in this. Okay, but we use those gains or those losses, excuse me, to offset the gains. So if we sold $5,000 loss and we had a $10,000 gain, we would just net those out to have a $5,000 gain that goes on to our 1040, our tax return that we pay taxes on at those capital gains rates. Most people, that's 15%. Okay. Now, if the losses exceed the gains, say we have $10,000 in losses and $5,000 of gains, okay, we'll use 5,000 losses to offset the gain, and then we have $5,000 left to offset ordinary income. But we're only allowed to use 3,000 to offset ordinary income. What happens with the other two? Well, it's just carried forward to the next year. Okay, so these are called loss carry forwards. And essentially what happens here is next year we can use $2,000 to offset gain or $2,000 to offset ordinary income. Gains are always offset first, capital gains are always offset first, and then ordinary at the end. Okay, so there's ways to do this to offset, for those that are in a higher tax bracket that don't want to take gains. Losses are great. We can get $3,000 off of our taxable income, which is fantastic. Okay, so these are our simple ways to lower taxes that almost everyone can take advantage of. Okay, so ultimately saying here, how do we look at this? And these are just 5 main ways to do this. Okay, so many more. Remember, your tax return is your financial fingerprint. So if you want to know, like, how would you go about this? You have no idea what's going on. You don't know how to read a tax return. You don't know how to do these. That's what somebody like us is here to do. So what does this look like for you? Well, we just started this new complimentary thing that are for the participants in the 401k plans that the Noble Group advises on. And I wanted to show you guys that today and how you can take advantage. Again, complimentary just helps kind of position everything together where you can take it and run with it on your own, or we're happy to help anywhere we can. Okay, so we're going to look at this here in a second, and then we're going to get to the Q&A. Okay, so this is a system that we use that basically takes everything that you have and puts it all on one page. We call it an asset map. Okay, and it's your family, it's you if you're individual, but it just puts everything out there from insurance to assets to income to debt, everything in there. The great thing about this is you get a link or you fill out a QR code, and it takes about 10 or 15 minutes to fill this whole thing out. Okay. So you get this, and again, this is all complimentary. We just want to help people know where they stand and where they're at. Okay. This is not our full financial planning system. If that's something that you ever wanted to use, just let us know, and we're happy to talk that a little bit deeper with you. Okay. But this, you get this map, and we get this thing that we call signals. Okay. This is really a cool concept that we've been trying to get out to you guys for quite a while now. And now it's all here ready to go. But it's basically, the signals are indicators for financial preparedness of a household to fund sustained losses due to something. Okay. Long-term disability, loss of life, longevity. We live too long. Okay. All of these are in there. So, and these might matter something to somebody different. Okay. So, longevity, can we retire till we're 95? Can we retire till we're 85? Everyone's going to be a little bit different. Okay. So we have these signals, and these are all kind of automatic in there. Green does not necessarily mean great. It just means, hey, we think we're prepared for this. Let's maybe look at this a little deeper to make sure we are. Okay. Red also doesn't mean that, hey, it's so bad. It just means, hey, maybe legal liability, maybe we don't have a will yet. We need to go get a will. Okay. Those are all things in here that that the signals tell us, where then we can put that to you and give you action plans to work on. Okay. And then we have target maps. Okay. Target maps are great. This is a little bit deeper into planning, but essentially this tells us how great, from a retirement funding standpoint, John and Sally Sample are 87% funded. Okay. And it's going to tell us how much do we need to contribute? What else does this look like? So these are really cool things that we're now going to provide to you guys on a complimentary basis. So take a look at these. If you want to fill out that questionnaire and go through it, please do. Just scan this QR code again, and I'll have a link in the email tomorrow for anybody that's interested. If you want to talk about it deeper first, there'll be some time, calendar link tomorrow in the email that I send with the recording, where you can schedule some time, and I'm happy to walk you guys through that. Okay. So let's look at an action plan. Okay. So things that you can do today that can help start your tax planning journey or further enhance it. Okay. Check your 401k contributions. Number one, make sure you're getting the full match. Okay. That's the free money. Okay. If you're putting in the traditional, but maybe it looks like a Roth 401k might be better, check that out. Okay. Get with your HR department, make sure you're putting in the right amount that you're needing to get that full match. And then anything else that you can save there, whether again, it's for a deduction or for that future tax-free income in the Roth 401k. Okay. Contribute to your IRA or your Roth for 2024. Okay. Remember, until April 15th, we can put money in for 2024. Okay. And then we can also put in for 2025. So if you have money laying around that you want to get in, again, remember, we've got to control that modified adjusted gross income. That's for deductions and phase outs of being able to contribute. But check that. If you haven't contributed for 2024, do that by April 15th if that's something that you're able to do. If you're not signed up for an HSA or you're not maxing that out, I don't always recommend to max it out, but it's something where, again, we get a triple tax benefit and nobody else gets those. Okay. Or nothing else gives that. So it's a great way to lower our income that we're taxed on, get tax-free growth, and use it for medical expenses either now or long into the future. Okay. Harvest gains and losses. Okay. We typically do this throughout the year, but a lot of times we see this done at the end of the year. But these are things that you can start to do now. If you have losses in there, maybe you're not happy with that position that you're in, the security, the ETF, the equity, whatever it may be. If you sell it now, just don't buy it back for another 31 days. Okay. Wait 31 days and then you can buy it back. Okay. As long as you also haven't bought it in the previous 30 days. Okay. So those are things. Now, when we talk about harvesting gains, that's also something. Maybe you have some losses already there and we have some gains. Take some of the gains off the table and pare them down with the losses. Okay. So, and then what I always say, gather your charitable gift info. So if you're doing your own taxes, you're using a CPA, get them that charitable gift info so they can decide if you're using itemized or standard. Also, learn more about donor advised funds, learn more about charitable gifting. We've got tons of things on our YouTube channel that discuss this. So please use that as a resource. Okay? And again, if you want that asset map, please scan this QR code. It's absolutely complimentary. No calls to action, no anything. Just fill it out. We'll get it to you. And if we want to discuss it, we can. Okay. So with that, we're going to jump into some questions that we've seen out here. Okay. So first question is, how is Social Security taxed? Great question. Typically, we hear that question from people either getting close to retiring or already retired, just haven't taken Social Security. We will do a Social Security webinar in May. Don't hold me to that, but I'm pretty sure it's May. So we'll explain that a little bit deeper. But essentially, everybody's different. It depends on your total income. So if you're getting there close to taking Social Security, we'll need to look at your future income and everything to determine. But essentially, up to 85% of your Social Security can become taxable to you as income, depending on your other income sources. Again, that YouTube video on the dividends and capital gains talks about retiring early. That will kind of weigh in on the Social Security tax as well, if you want to get out there at the Noble Group YouTube channel there. So great question. Can you explain modified adjusted gross income again? Yes. So modified adjusted gross income, while not used for a lot of things in the tax return, you actually won't even find it on your 1040. There's a modified adjusted gross income calculation worksheet way in the back of the tax return that most people don't even have, because most people's adjusted gross income is their modified adjusted gross income. So, but essentially it's adjusted gross income. That's your gross income minus your above the line deductions to get to adjusted gross income, plus any deductions you got for certain things like tax exempt interest. Okay. So if you have a muni bond portfolio or something like that, that's kicking off tax exempt interest. You have to add that back in to create modified adjusted. And then that's what the number that we use to determine phase outs or deductions for a lot of, phase outs for deductions or credits or things that we get, okay, from the tax return. Okay, and then another question here. I'm about to retire. What do I need to worry about? Loaded question, great question though. We typically recommend when you're about to retire, some people do this on their own and perfectly fine. We've seen very happy retirements, fulfilling retirements done on their own. But we do recommend that you talk to somebody at the minimum. You don't necessarily have to work with them, but there's a lot of things that retirement planners such as the Noble Group, but there's many other good ones out there too, that we see day in and day out that maybe you don't. And so you don't know what you don't know. And so that's my big recommendation. You're only going to retire once, okay? Most people, you're only going to retire once. Let's keep it that way. So it's probably worth your time and effort. Spend an hour, spend a couple hours, getting all that put together. That's going to be really important. Okay. So, and then last question. HSA. Okay. Yeah. Can you sign up for an HSA if your employer doesn't offer it? The answer is yes, you can. That's a little bit deeper, but a quick Google search will show you where you can go. You can open those up at quite a few different places. We don't open those for clients personally because it's kind of on the side, and then you can get them invested. You can do all those things. But most employers will offer those. If yours doesn't, give us a call. We can lead you in the right direction. But typically a good Google search of how do I open an HSA will do that. And again, couple of weeks from now, we'll have a webinar that kind of goes through that a little bit deeper. So, all right. Well, that's it for today. Appreciate everyone joining us today. And again, anything comes up, please don't hesitate to reach out to us. We're here as a resource for you guys any way that we can be. And again, I'll follow up tomorrow with an email, and we'll go from there. So we'll look forward to seeing you guys in a couple of weeks, and y'all have a great rest of your day.